Today we're joined by Gerald Stack, the Head of Investments and the Portfolio Manager of the Magellan Infrastructure Fund. Gerald, can you tell us a little bit about your background and that of your investment team?
Okay, so in our investment team we've got about 9 people who really influence what we're doing. 3 PMs, Dennis Eager, Steve Menzies and myself, and 6 analysts in the team. Dennis Eager and myself and a guy called Chris Webster, one of the analysts who's actually based in New York, all came across from a firm known as Capital Partners, now known as CP2. And we'd worked there together for about 4 years. I'd been at Capital Partners for about 9 years. Capital Partners was an infrastructure specialist, focusing both on listed and unlisted infrastructure assets and really working for wholesale investors, institutional investors. So we'd worked together for about 4 or 5 years. We've been here together for close on 10 years now, so the 3 of us have worked together for near on 15 years. Prior to Capital Partners, my background in infrastructure started back in around about 1993, where I worked at AIDC, Australian Industry Development Corporation, and there I was involved in investing in unlisted infrastructure assets. So my career in infrastructure started out too long ago. Investing in unlisted infrastructure over time, I've morphed into a listed infrastructure asset. The infrastructure has been the commonality in it over time. Dennis said came from Capital Partners. Before that he was at Macquarie, and prior to that Leighton's. Again, more than 20 years experience, in particular in infrastructure asset development, but also in management of assets over time. And then across the team we've got a range of experience that really cuts across investment, on asset delivery, on operations, really across the infrastructure asset spectrum.
How is your investment team aligned with investors?
So I guess there's 2 or 3 ways. Firstly, we're all investors in Magellan. Really everyone at Magellan has the ability to participate in the purchase of Magellan shares through a loan scheme, which is then repaid over time. In addition to that, then we are investors in the fund, I actually don't know the exact level at which people are invested in the fund. That's to their privacy, as it were, but I can tell you that the 2 PMs, the main PMs, Dennis and myself, have invested in the fund since day one and continue to do so.
Gerald, I'd like to spend a little bit more time now on understanding the research process behind Magellan, with a particular reference to the Magellan Infrastructure Fund. What do you define as infrastructure assets?
The key thing that we look for when we're defining an asset as an infrastructure asset is that it delivers reliable returns over time. When investors seek to invest in infrastructure, what they're after is reliable returns, irrespective of economic circumstances. Now, most infrastructure investors, when they listed or unlisted, what they define as infrastructure is, or the way that they define it is to badge it as an essential asset. In other words, an asset that provides a service that's essential for the efficient functioning of a community. That's important from an investment perspective because it means demand is reliable. Now that's interesting, but as far as we're concerned, that doesn't mean reliable returns. So we take the group of assets that are essential assets and we apply another filter. And that filter is that there's no external variables affecting cash flow. So not only is demand reliable, but earnings are reliable. So what we're particularly trying to screen out is anything that faces competition, commodity price risk, or sovereign risk. So sovereign risk, China's out. We won't invest in China. There's some wonderfully attractive macro themes as they apply to infrastructure in China, but we don't think assets in China deliver you reliable cash flows because of the impact of sovereign issues. Anything with commodity price, oil or gas price impacts on earnings, again, we won't be there, and similarly competition.
What is the investment philosophy behind the strategy?
So the investment philosophy ultimately is to deliver investors reliable returns through an economic cycle. That's what we think infrastructure delivers you, and if we define the asset class the right way, we'll deliver you reliable returns and deliver diversification benefits to a portfolio. So what are those investment returns? Well, measured on a typical WACC DCF CAPM basis, we should expect something of the order of real returns of 5%. So CPI plus 5 in nominal terms. If we go about our definition properly, then we should be very confident about capital protection along the way. So if you like, our 2 investment objectives within that philosophy are capital preservation and returns consistent with the sector of CPI plus 5.
What factors do you assess in selecting stocks for the portfolio?
Okay, so there's really 3 parts to our investment process. The first is bottom-up stock selection. The second is top-down macro analysis, and the third is portfolio construction. Each of them affect the composition of the portfolio, and each of them we're seeking to add value to the portfolio over time. So bottom up, stock and sector analysis and selection. What we're looking for is assets that fundamentally we believe are cheap on a fundamental basis, assessed on a WACC DCF basis. In addition to that valuation overlay, what we're doing is seeking to assess companies on a quality spectrum with a real focus in particular on agency risk and business risk. The nature of infrastructure assets is that you build a big ugly piece of capital equipment up front, and in return for that you get a long series of very reliable cash flows. So making sure that management and the board are on your side and that those reliable cash flows come back to you, the investor, is really quite critical with infrastructure. So agency risk, a big issue. The second is business risk, and business risk we think about or we define as really the predictability of cash flows, the forecastability of cash flows over a 3 to 5 year time frame. It's one thing to forecast cash flows as entirely predictable. Well, what's your track record of the company actually achieving that over time? How confident can we be in our own forecasts? So they're the two things that we look for in addition to that valuation overlay to begin with. We're seeking to find the cheapest stocks that meet those two criteria. That's our bottom-up stock and sector analysis. Top-down macro analysis, what we're seeking to do is really two things. Trend identification, try and find those regions and countries, communities where there are positive things going on that we want to be exposed to. That might be a really robust economic growth, and we may therefore want to be exposed to airports or rail, indeed, in those sorts of regions. So that's one particular flavour of macroeconomic analysis. The other part for us is macro event risk mitigation. So if you like, trying to avoid the Spains or the Greases of this world before they become a problem. They're the two things we look for out of macro. So that's stock and sector analysis, bottom up, top down, and the final piece is portfolio construction. And ultimately within the stocks that we've assembled, we're seeking to move ourselves across sectors, across geographies, to make sure that no matter what the economic circumstances that are thrown at us, we deliver to our investment objective. That's CPI plus 5 over time.
You manage a concentrated portfolio of around 20 to 40 companies. How do you manage concentration risk?
So we've talked already a little bit about our investment process and that there's a macro analysis is a driver of our portfolio construction, and that also portfolio construction is of itself a key driver. And we have a range of risk filters, risk parameters that lead to the way that we structure the portfolio. In essence, our universe is roughly, our investment universe is about 140 stocks in global listed infrastructure securities, as we define it. And of that 140 stocks, about 60% are utilities and 40% are infrastructure. We expect through a cycle to be roughly 50-50, 50% infrastructure, 50% utilities, so slightly underweight utilities and slightly overweight infrastructure. Why? Well, utilities, the way they earn returns is they earn a return on their capital base, a regulated return on their capital base. It's a fair return, but it's not get wealthy quick, not get rich quick. It's driving values progressively in a formulaic manner over time. That regulation is transparent, it's well understood, and as a result those things should trade close to underlying intrinsic value under most circumstances. That's the utility space. It's not a place where you're typically looking to add alpha, as it were. On the flip side, the infrastructure part of your portfolio, it's generally price that gets regulated rather than earnings. And therefore, if we can find infrastructure assets, toll roads or airports, where volumes are stronger for longer, then we can find assets where the return on capital is high and growing and arguably not necessarily respected by investors more widely. So that's the opportunity to find things that potentially are quite cheap. So we expect to be, through a cycle, somewhat overweight infrastructure, somewhat underweight utilities. That's important from a concentration risk because that's how we look at our portfolio. We're looking over time to be roughly 50-50 in each of those two components and to manage our stock selection within the different components of those two sectors accordingly.
What are the unique risk factors associated with infrastructure assets?
So there are really two key risks when it comes to infrastructure. It's a long duration asset class, so real interest rates, real bond rates are a key risk, and there's no getting away from that, the same as for all long duration asset classes. That's number one. Number two is a government/sovereign risk. The nature of infrastructure assets is they're generally monopolies, they're regulated by governments, and therefore the predictability, the reliability of that regulation and of government behaviour over time is a key risk. As I've mentioned already, you build an infrastructure asset, there's a whole heap of capital up front, you're then relying upon a long series of reliable cash flows into the future. Relying on the regulatory or government framework that supports that is critical. They're the two key risks.
You focus on the long term. How does your investment process relate back to the investment timeframe recommended for investors?
So a key part of our valuation process, our investment process, is stock and sector analysis. That stock and sector analysis is struck on long-term parameters. We value every asset on a WACC DCF basis. Our parameters within that, whether it's our market risk premium, our beta, the way that we think about the way that traffic or passengers at an airport are going to grow over time, are struck on long-term parameters. We're seeking to identify assets where essentially intrinsic value is pretty stable over time. And when those values, when market price moves away from value, then we can invest in that in a confident manner. So our valuation framework, the key plank of the way that we put this portfolio together, is very much struck on a long-term basis. And that's why we were confident about the nature of the returns that we'll deliver from this asset class over the long term. Markets will throw up what markets will throw up in the short term, but we can be very confident that if we invest in these assets, given that they've got somewhat bulletproof franchises over time, that ultimately market price will reflect underlying cash flow. And if that's the case, these assets will deliver to our thesis as we expect.